Good morning and welcome to today's webcast, How Tax Reform Could Impact Tax-Exempt Organizations. Before we begin, we're going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Moss Adams Not-for-Profit Group, Tracy Paglia, Partner, and Lauren Haverlock, Senior Manager. Tracy, I will now turn the line over to you to get us started.
Terrific. Thank you so much, Emily. And thank you, everyone, for joining us today. We have quite a lot of material to go through today, but if you do run across questions as we go along that you'd like to have answered, please enter them in the chat box. We will try and get to them if we have time. If not, we'll get back to you afterwards. But do ask those questions. We are getting tons of questions when we talk about this topic. Of course, we don't have all the answers yet with tax reform being brand new, but we're certainly happy to take the questions. The topics we're going to cover today are broken into the following categories. We've got compensation and fringe benefits. I'm going to then turn it over to Lauren, who's going to talk about unrelated business income and the business provisions that may affect people on the call today. We're going to go briefly over the international pieces, which is a huge part of the changes, but still a little uncertain on how it's going to affect exempt organizations, so we'll talk about that for a bit. I'll come back in and talk about other provisions that you may find affect your organization, and then provisions you may have heard of during all of the discussion going through the Senate and the House, but that didn't actually pass in final legislation. I find it's helpful to have that information in one spot just because tax reform was such a widely publicized process that there were provisions you may have been concerned about that didn't actually make it in. Now, it doesn't mean they're gone for good. They could come back and resurface in future legislation, but for now, didn't make it into what we're going to talk about today. So as an overview for people who aren't quite aware of how this all came about, President Trump signed H.R. 1, which is the Tax Cuts and Job Act legislation, into law just before Christmas on December 22nd. It is the most widespread change to the Internal Revenue Code in over 30 years, so it's certainly been a lot of work and analysis on our end trying to understand the provisions, but there will be much more work to come as we get regulations, as issues are litigated, as we start finding the pitfalls with this quickly processed bill. Most of the provisions went into effect for years beginning after 12/31/17. Many of the provisions affecting individuals are expiring after 2025. So like much of the tax legislation that's passed, we do have provisions that sunset, although pretty much everything we're talking about today doesn't have a sunset to it. So we'll let you know about those as we go along. And then this tax bill is projected to increase the deficit by $1.5 trillion in the projections that were done as part of tax reform. So it's certainly not a balanced bill. So with that, we're going to start with our first poll. Please remember you need to answer the polls in order to get credit, and we also like to get feedback from our audience since this is kind of a one-way venue here. How informed are you about tax reform? So are you an expert? You've studied it all. You could get on this webcast and teach this with us. It's advanced. You're advanced. You're fairly aware of most provisions. Maybe you've been attending other webcasts, reading other alerts. You're just a beginner. You're somewhat aware of some provisions but still have a ways to go. Or this is the first time that you've heard of tax reform, maybe the first webcast you've attended. So if you could please check one of the radio boxes and click Submit so that your answer is recorded. We'll give you just a few seconds here so you have time to submit your answer. And that hopefully is enough time. Hopefully you're all paying attention this early in the webcast. So our response rate that we've got a few experts on the call with us today. We have a chunk that is advanced. Most people are beginners, so I think that's probably a good chunk of the people that we're running into, as you've heard some things, but are certainly not feeling very advanced yet, and a few who this is their first time that they've heard about tax reform. So thank you for joining us and letting us be part of your education process. So with that, we'll jump right into compensation. So tax-exempt organizations now have a brand new 21% excise tax that is due from the exempt organization. This is not a tax on the employee. This is on the employer. And it's only for covered employees who are paid in excess of $1 million by the filing and related organizations during the year. So you can't get around these rules by splitting compensation between a couple different related organizations. You got to consider all related organizations in this $1 million threshold. It also applies if an employee of an exempt organization receives an excess parachute payment that was paid to a covered employee. So those are probably going to be few and far between, but we want to make sure that we're keeping you abreast of what that is. So we can exclude from this compensation calculation amounts paid to licensed medical professionals when the services are directly related to the performance of medical or veterinary services. So if you have a physician who is in an administrative role, say in your hospital, their compensation all has to be considered. But if they're paid partly for administrative duties and then partly for, say, conducting surgeries or doing rounds or other medical professional services, you can exclude that portion of their compensation from this potential calculation. Covered employees are current or former employees. If they're one of your 5 highest paid employees for the year, this is different from your 5 highest paid that we report on Part 7. This is just looking at all of your employees paid by the filing related organizations and looking at, are they one of my top 5 paid? And if so, for the current year, they are a covered employee. And they will continue to be a covered employee after that, because the second bullet point there is that they were a covered employee for any tax year after 12/31/16. So once you're in that 5 highest paid bucket, then you will continue in that role as a potential covered employee to be subject to this 21% excise tax paid by the exempt organization. So you've got to watch for 457F benefits in the year of vesting, because that vesting is treated for these purposes in the year of vesting, not when it's earned. So if I have a 5-year 457F non-qualified deferred comp plan, where if I stay for 5 years, I get $1 million, in the year of vesting, I'm almost certainly, of course, going to be over that $1 million threshold, because that vesting is in addition to my base compensation. Now, the excess parachute payments come into play with these severance payments, because those excess parachute payments have to be paid in relation to leaving employment. So it's typically going to be your severance, not your 457F. And those payments themselves need to be over certain thresholds is that kind of a 3 times of your average 5-year compensation. So they have to be pretty significant severance payments or similar parachute payments in order to get caught in that bullet point. Now, that excess parachute payment doesn't have to take you over $1 million. It can keep you under $1 million, but still the excess amount would be taxable at the 21%. When we're talking about the $1 million threshold, the amount subject to the 21% is the amount over $1 million. When we're talking about the excess parachute payments, the 21% is in relation only to the excess over that 3 times your 5-year average. So there's still lots of questions on this topic, but since it is a brand new excise tax, but we've had something similar in the SEC realm for a while, so chances are that's where our guidance is mostly going to come from. This is going to apply to exempt organizations that are exempt under 501A1, so your typical exempt organizations that you'd think of, 501c3 charities, your hospitals, your schools. It also applies to farmers' cooperative organizations, public utilities, organizations that are exempt under 115 because they are exercising essential government functions of a state or political subdivision, and also to 527 political organizations. So when they're talking about tax-exempt organizations, they're not just talking about what you'd automatically think of as charitable or exempt. We also have these other groups that are getting caught in this new excise tax. Before I go to fringe benefits, we don't know yet how this is going to be assessed or paid. We don't know if it's going to be an additional line on a 990T, kind of like the proxy tax is on the second page, or if it's going to be a completely different form. The other question is it is for years beginning after 1/1/17, so years beginning after 12/31/17. So we're not sure quite how this deals with fiscal year exempt organizations. If you're a 6/30 year end, is the comp you're paying today subject to the 21%, or is it only subject for your year beginning, say 7/1/18 and forward? Because it's compensation, and compensation is usually a calendar year item, best guess is it will apply right now based on a calendar year, but clarification will need to come out on that from the service before we know for sure. So definitely stay tuned on that if you're paying anyone over $1 million or you have large severance payments. The next area of comp and benefits are fringe benefits. This is where we're going to see more exempt organizations get affected. So the first one are your employee achievement awards. And this applies whether you're a tax-exempt organization or a for-profit. Before the reform went into play, you could exclude from wages awards for tangible personal property, but that was not clearly defined, and it was up to certain thresholds. This is for your length of service awards. Think your gold watch at retirement type situation, or a 5-year of service type award. Under the Reform Act, effective for awards given 1/1/18 or later, tangible personal property specifically excludes cash, cash equivalents, gift cards, vacations, meals, lodging, theater or sporting event tickets, stocks, or similar items. So if you're giving these types of items as a length of service award, those are now going to be taxable to the employee. You can't exclude them. We always knew that cash and cash equivalents were going to be taxable, but really what this clarified was these lodging, vacations, event tickets, things of that nature don't qualify as tangible personal property, so they would be taxable. The second line that we have there is for moving expenses, and this could be a huge change for some of you. Before 1/1/18, so through 12/31/17, reimbursement of moving expenses for employees was excluded from their wages as long as they met a distance test and a time test. So if they could have deducted it on their personal return as a qualified moving expense, you could reimburse it tax-free and not have to worry about it. Now that's all been suspended. Individuals don't get to deduct moving expenses on their 1040s anymore, and employers, if they're going to reimburse any moving expenses, they're going to have to treat it as additional taxable compensation. Unfortunately, so far, the way the rule was written, this was a cutoff. So if you had employment agreements that were signed in 17 where the move wasn't happening until 18, that 18 reimbursement is still legally enforceable, but it's now going to be taxable. If you had an employee who moved in 17 but didn't request reimbursement until 18, that reimbursement is going to be taxable to them, even though the move happened in 17. It's when the reimbursement happens that matters. So some employers are having to scramble a little bit to figure out if you're still going to provide the benefit, or if you're going to discontinue the benefit or gross it up, or just notify your employees that it's going to be taxable. The next provision that was affected is on-premises athletic facilities. So prior to the tax reform, you could exclude from employee wages access to an on-premises athletic facility for free if Section 132 restrictions were met. So it had to be on the employer's premises. It had to be available to your employees, and the predominant use, substantially all of the use, had to be by your employees, spouses, or dependent children. If so, then you could provide that benefit tax-free. Now, a lot of my colleges and universities tried to give employees access to the normal athletic facilities that are mostly for students and say that was a tax-free benefit under this on-premises athletic facilities, but that did not qualify. That was always taxable, by the way. So if you weren't treating that as taxable already, tax reform didn't change that. It just highlights the issue. What tax reform made taxable were those on-premises athletic facilities that were only for or substantially for employee use, spouses, and dependents. So think about having an office building in San Francisco, and you have a small gym in the building that is available for the employees to use for free. Those are the types of athletic facilities. Or if you have, say, a Google campus where it's really only employees on site and you have this great athletic facility, that's going to be taxable now. The way that it's taxable is not to employees. It's a little counterintuitive. It's not a taxable benefit to employees now. Instead, for exempt employers, those expenses are going to be unrelated business income to the organization. So to the extent that you're paying for that machinery, that equipment, your rent includes an on-premises gym that you're paying for as part of your rent, those expenses paid for by the employer are going to be theoretically on your 990T as unrelated business income. It's a little counterintuitive. First time we've seen the IRS or Congress do this, but we have a couple benefits that are like that. This athletic facilities is just the first one. The next one, and one we're going to run into more often, are the qualified transportation fringes. So before, you could provide transit passes or parking up to certain thresholds and exclude it from employee wages. Now, if you subsidize those items, qualified parking, transit passes, van pools, those expenses paid for by the employer are going to be unrelated business income. Theoretically, we're thinking it has to be added to the 990T. There is an exception if it's to ensure safety of employees, say if they're working really late and it's unsafe for them to ride the transit and you pay for cab fare for them instead. Or it's after a holiday party, theoretically, and they've been drinking. And so for safety reasons, you are paying for transportation. Those types of things shouldn't be affected by this reform, but just your monthly parking, your monthly transit passes, if the employer is paying for them, it's now going to be unrelated business income. They didn't mess with the employee's ability to use pre-tax money to buy those benefits, so that's okay if it's coming out of the employee's pre-tax pocket. But if the employer is paying for it or subsidizing it, there could be unrelated business income there. Similarly, they've said qualified parking facilities are going to be treated the same way. So if an employer maintains a lot that's only for employees, we could be seeing additional unrelated business income for the cost of that parking structure. It's very uncertain at this time how that's all going to work, how you figure the cost, and what if it's a mixed-use lot? What if you would normally charge the public to use it, but you have certain employee spaces you let them use for free? Initial assessments look like part of that parking structure is going to have to be unrelated business income on your 990T, because they wanted to put parity for employers who have to buy third-party parking versus maintaining their own lot. That's kind of how it's shaking out, but more guidance is supposed to be coming on this. We just don't know how long it's going to take. But this is effective 1/1/18, so we're supposed to be figuring it out fairly quickly and including it on your 990T for your 18 filing. The final transportation benefit that has been out there is a bicycle commuting reimbursement. This one's different from how the other two were treated. Before you could exclude it from employee wages up to $20 a month for bicycle commuting. Now that exclusion is gone, so that will be additional taxable compensation to the employee. So that's not unrelated business income. That's just going to be additional taxable comp to the employee, similar to the moving fringe benefit. There is a new credit for paid leave for family and medical leave. It's a 12.5% credit that you can claim as a general business credit, which is claimed on a Form 3800 on your 990T. There are certain eligibility requirements in order to get this credit. One of them is that you've got to have a written policy for the leave. You have to provide at least 2 weeks leave, and you can get a credit for up to 12 weeks. But this wouldn't qualify if they're using vacation leave, normal sick leave, or normal personal leave. This is very specific for family and medical leave. It can't be required for or paid by the state. And it can be up to a 25% credit, but I think it's going to be pretty narrowly used just because of the exceptions. People are going to use their vacation and sick pay first. They may have a short-term disability policy or a long-term disability policy, all of those that kick in before any sort of family or medical leave. So depending on the employer policies, though, you could get a credit. It's only good for 18 and 19 wages right now, but we'll see if it's extended at a later point. So brand new credit. I'm going to turn it over to Lauren now for unrelated business income tax.
Thank you, Tracy. So I have the honor of covering the changes to the unrelated business income tax regime. And just as a refresher, unrelated business income is trade or business regularly carried on by an exempt organization that's not related to an organization's exempt purpose. And where we generally see this for a lot of our clients is areas like debt-financed investment income, advertising, services provided outside of an organization's exempt purpose, administrative services provided to other organizations or nonprofits. A lot of our credit unions have a great amount of unrelated business activities that stem from their business, but it might be provided to members or to non-members. It might be business lines that are slightly outside of what's defined by the IRS. So a lot of our organizations, I'd say most of them, have unrelated business income, especially now as more organizations are invested in alternative types of investments that produce K-1s and investments in partnerships. So the changes to the unrelated business income tax come from two main sources. One is a direct change to UBI, and so this is something that impacts exempt organizations only. On the list that I have of the main changes that we're going to reflect on, the disallowed fringe benefits that Tracy just spoke about, as well as unrelated business activity bucketing or siloing, those are the two main changes that are impacting exempt organizations only. The other changes that impact unrelated business income come from general changes to the corporate code. So NOL limits, that's the change to the corporate provisions, as well as change to the corporate tax rate, elimination of alternative minimum tax, and some other ones that we'll discuss briefly. As you can see, the two changes that impact exempt organizations are not so positive. Disallowing the fringe benefits and requiring them to be recorded as income isn't something that I think most organizations are excited about. Same thing with the siloing and the bucketing of unrelated business activities. But the other corporate changes, the corporate provisions, could generally possibly be seen as positive, maybe with the exception of that NOL limitation, although indefinite carry forward is a positive thing. So let's jump into a little bit more detail about each of these items. So while Tracy discussed the details of the fringe benefits, there's a couple things that I wanted to highlight in that the inclusion of fringe benefits as income is meant to close the tax gap. So for the corporations that are no longer allowed to take a deduction for these items, so exempt organizations are supposed to pay tax on them as revenue. If an organization has unrelated business income and one of these fringe benefits should have been a reduction to that UBI, you do not have to include it as income. So restated, if a fringe benefit would have been a tax deduction and we're no longer taking it as a tax deduction, you don't also have to take it as income. So that's something that organizations should be aware of, to not have that double taxation in that sense. And as Tracy noted, there are some of the fringe benefits that are just supposed to be taxed as they're taxable to the employee. And if they're taxable to the employee, if the employee is counting that as taxable income, those won't have to be included as unrelated business income as well. Something else to note is that these are for amounts paid or incurred after December 31st, 2017. For our 2018 calendar year-end clients, this is a clean break, so we'll have to start tracking this for our 2018 tax return. But for organizations that have a fiscal year end, that is something that may have to be reported on the 2017 tax form for your fiscal year ending within 2018. So if an organization is a 6/30 year-end, a June year-end filer, then they might have 6 months of a fringe benefit to report on their 2007 990T for that 6/30/18 year-end. And looking at the 2017 form and instructions, which have come out recently, doesn't have any provisions or details as to how this is recorded. So this is something that we'll wait to get a little bit more information on for our organizations. Another thing that's a pretty hot topic with nonprofit organizations is UBI activity bucketing. So organizations that carry on more than one unrelated business activity have historically been able to report them all in aggregate. So that means the profit, the income, the expenses, while they're generally separately tracked, on the Form 990T, everything is lumped together and aggregated so that losses from one activity are able to offset net income from another activity in a given year. NOLs produced you've been able to carry those forward, no limitations as to what those NOLs will apply to. Well, now that has changed for exempt organizations only. Now, of course, this doesn't impact corporations, but for nonprofits, this is something that we're going to have to focus on and look at a little bit more. So now deductions from one activity cannot offset income from another activity. That leads to two huge issues for exempt organization. This is going to create separate business lines for unrelated business income, and those separate business lines will have to be separately tracked, and NOLs will have to be separately tracked, and organizations will have to keep each cost center. They'll have to allocate overhead expenses amongst their unrelated business income activities, so they'll have to come up with ways and methodologies that are reasonable to allocate those overhead expenses amongst those. This is applicable for tax years beginning after December 31st, 2017. So for you calendar year-end organizations, right now this applies to you. This is something that you will have to account for when you make your estimated tax payments if you are considered a large corporation and have to make quarterly estimated tax payments. This is something that our fiscal year-end filers will want to begin to think about, maybe as they're preparing, as you're closing out your calendar year-end, your fiscal year-end that ends in 2018. You might want to look to see how UBI is impacted for the upcoming year. There's a lot that we don't know here. So there's a lot that we don't have a definition of. And the main thing is, what is the definition of an activity for an exempt organization? Some are pretty obvious. If an organization has advertising and they have debt finance rental income, those seem like two separate activities, and those can be separately tracked. But what about organizations that have investments in alternatives? They receive K-1s, and those K-1s flow through trade or business income on line one of those K-1s. Is that unrelated business income that's allocated on those K-1s? Is that itself one activity? Or do we have to look through that K-1 to see what each of those activities are? Now, I'm hoping for our sake and for our client's sake that K-1s are seen as, and the alternatives are seen as one activity so that we can at least aggregate those all together. But at this point, we don't have a definition and we don't have clarification on that. I see this as a big impact for our universities that have a variety of unrelated business activities, and also for credit unions that have UBI basically mandated from the IRS on warranties and various insurances and fees for ATM fees for non-members. Those are all, we don't know if those themselves are each going to be separate activities or if they can all be lumped together as one activity for credit unions. So I had an example that didn't quite make it to this presentation, but I want to highlight the impact, and this will be in the presentation that we send out to you all. But I want to highlight the impact. So in this example, we have an organization that has a rental loss of $400,000, K1 losses of $500,000, web advertising income of $250,000, printing services of $50,000, and a disallowed fringe income of $50,000. Now, I don't expect you all to add those up, but together that totals up to a loss of nearly $500,000 if you aggregate those net income and losses. This organization generally would not have to worry about UBI for this year, and they could feel good knowing that in the future they have an NOL carry forward of $500,000, nearly $500,000 to cover anything in the future. But under the new rules, under the new UBI siloing rules, now the organization, whereas before they would have no tax due and an NOL carry forward of $500,000, now they're going to have tax due of $73,000 and NOL carry forwards of $500,000, which would only be applicable to alternative investments, and $400,000, which would only be applicable to their rental activities. So those NOLs are basically not going to be useful for the organization, but they have a lot more tax. This is something that will have a big impact for organizations. And like I said, if you are if you have UBI of over $1 million of receipts, this is something that you'll have to track on a quarterly basis as you prepare your quarterly estimated tax payments. So with that, we have come to our second polling question. This is just trying to understand for the participants, how many unrelated business activities would you estimate that you have? The answers here, and I'll give about 20 or 30 seconds for everyone to respond. The answers here are none. We have no unrelated business income activities. One, bucketing doesn't scare me. It doesn't apply. A couple, there may be some impact, but we're not worried. Or several activities. We will definitely feel a financial impact from bucketing. So if you can just take a quick look at that, and we'll see how everyone responds. This is something that in theory seems really terrifying, and for a lot of our organizations will have a big impact, but in reality, maybe it won't impact a large amount of participants here on this webinar. So let's just take a quick look and see. So we can see how it's broken out. There's about 28% of participants don't have any UBI. 14% have one activity. So bucketing really isn't too scary right now, but it's something that could be impactful in the future. Most have a couple UBI unrelated activities, but they're not too concerned. But there's a good amount, 1/5 of participants, that have several activities and plan or hope or think that they'll feel a financial impact from bucketing. We referred to a little bit to net operating losses when I just discussed the bucketing changes. Now, moving forward after January 1st, 2018, organizations are going to have to separately track their NOL buckets. One benefit that was on the slide is that if an organization has NOLs that exist from before 12/31/17, if you have NOLs from before that time, those still retain their characteristic as a general NOL that can apply to any of your activities and are basically kind of like a golden ticket. You can use it to apply towards anything, a free bingo square or a wild card, whatever you want to refer to it as. Those old NOLs are golden to you, to your organization. So that's going to be important. Now, however, moving forward, there's going to be a little bit of some limitations and some reductions to the usefulness of NOLs as we see it when you combine the siloing and these changes. So the downside to these changes to the NOLs are that now moving forward, NOLs that are that are from tax years beginning after December 31st, 2017. So if you're a calendar year end, that's 1/1/18. If you're a fiscal year end, that's going to be your fiscal year beginning in 2018. In those years, NOL carryforwards are limited to 80% of your taxable income. So NOLs going forward in the future, the new ones that are created, will never be able to fully offset your taxable income for that particular silo of income. Another downside is that the NOLs have lost the ability to be carried back for 2 years. In the past, you had a 2-year carryback. So if 1 year you had a loss, but you know that in the past 2 years you had unrelated business income that you had paid taxes on, you could use that loss in the current year, amend your prior 2-year returns, and get a refund today for that money. So that NOL had value on that day. That no longer is applicable for NOLs. One benefit, one positive to the change is that now NOLs are carried forward indefinitely. So there's no limitation to when those end. Right now it's 20 years for NOLs that are incurred before 1/1/18. It's a 20-year period. But one quick thing to note is if you'll notice, NOL carryforward, the changes to the carryforward carryback start for tax years ending after 12/31/17. So for organizations that are calendar year end, that's your 2018 calendar year. But if you're a fiscal year end filer, there is a bit of a difference in the applicability of this second bullet point and the first 80% limitation bullet point, and I'll highlight that in a second. So there's another layer of confusion. We discussed that the old NOLs from before are able to offset 100% of your taxable income. They're not subject to UBI bucketing, but these new NOLs are going to retain different characteristics. This also impacts the valuation of the NOLs for ASC 740, as we discussed there for financial statements. There's a really good way to highlight how this NOL change and this kind of transition, this awkward transition year that we have will present itself for organizations. Now, this is, of course, if there's no correction made. Some practitioners think that there could be a correction made to this for tax years beginning after December 31st and tax years ending after December 31st, because that might have been a mistake. So there could be a technical correction made for this. But as it stands right now, we've created a chart that highlights the 3 different ways that an organization that's a fiscal year end filer will have to track their NOLs. So for NOLs that are from before 12/31/17, free range. They've got 2-year carryback. They're limited to 20-year carryforward, but they're allowable to offset 100% of taxable income in the year that they're used, and you can use them for any bucket of activity that you need them for. So these are the wildcard NOLs. For NOLs for fiscal years ending after 12/31/17, so if you're a 6/30 year end, for your NOLs that are created in your 6/30/18 year end, there's no carryback and an indefinite carryforward. You can use them 100% of taxable income in the year that they're used because that 80% provision doesn't apply, and they're not subject to bucketing because the bucketing doesn't come into play for tax years beginning after 12/31/17. And so, but finally, if you're a fiscal year end filer, if you're that 6/30 year end filer, as of 7/1/18, those NOLs are subject to all the rules. So you have no carryback, indefinite carryforward, limited to 80% of taxable income for the year used, and they're also subject to bucketing, the UBI siloing. On top of that, something we don't really mention here because everyone's got a different state that they're in. We have participants from all over the U.S. on this webinar. A lot of states have their own rules for NOL. So not only do you have these limitations and these changes in these 3 periods to account for, you also have your state NOL to account for. And every state conforms in a different way to the NOL rules, and every state conforms in a different way to unrelated business income. So states and federal, we don't know how those are going to match up in the upcoming years when it comes to that. Well, I guess a little bit of good news, if we want to have some good news in the UBI area, is that the reduction in the corporate tax rate also applies to unrelated business income. So now it's a little bit less expensive for an organization to have unrelated business activities or unrelated business income. The corporate rate changed from 35% to 21% for tax years beginning after December 31st, 2017. So once again, if you're a calendar year-end filer, this is a clean break. 2018 is a new year and you have 21%. But for fiscal year-end filers, you're going to have this year having a blended tax rate. So for your 6/30/18 year-end filer that we've used as an example throughout this webinar, you're going to have half of the year at 35%, half of the year at 21%. Luckily, the IRS has given us some relief in that we don't have to actually separate out the activities that were before December 31st, 2017 and apply a 35% rate to that half year and then have the cutoff that starts in 2018 for the other half year at 21%. They're just allowing us to blend the rate and apply it to the entire year. So you can see here the 35% rate would be reduced to 28% for 6 months at 35 and 6 months at 21 for the fiscal year ending 6/30/18. So this is something that is going to have to be taken into account for your ASC 740 footnote and disclosure if you are reporting income tax there. The deferred taxes are going to need to be measured at the rate that it's applicable. Another provision to mention that I don't have a slide for here, but before we get to these other business provisions here, is that there is now AMT has been eliminated. Corporate AMT has been eliminated. So this didn't really apply to a lot of our organizations that were that reported unrelated business income tax. It applies to a lot of our organizations that have corporations, that have related corporations. But before, if an organization was not considered a small corporation, so if they had gross receipts, unrelated business income gross receipts, or if they had activities that had over $7.5 million in income in a given year, gross receipts in a given year, and that was a limitation for a small corporation. If an organization was not a small corporation, they were subject to the alternative minimum tax, which reduced the NOL a little bit. It limited the usage of the NOL, and it applied a different tax rate. Now that's completely eliminated going forward. So corporations don't have to worry about the NOL moving forward. We discussed the state impacts a little bit, but here are some of the other business provisions that will impact both unrelated business income tax as well as corporations if you have a corporation that you are related to or file for. So bonus depreciation and 179 deductions are expanded. Basically, that's a benefit to organizations because you can expense your investments in the year that you spend your money. There's new deductions for pass-through income, expanded access to cash methods of accounting, limitations for the deductions of business interest for businesses with an average gross receipts of more than $25 million. A DPAD is repealed for tax years beginning after 12/31/17, and there are changes to R&D expenses beginning in 2022. We have a nice description on the 20%, a nice illustration of the 20% deduction for qualified business income under Section 199A, if that's applicable to your organization. So something that's a good resource if that's something that applies to you. I've also included in the slides a little bit of a comparison to the pre-reform law and the Reform Act under the unrelated business income regime. So if you want to look and compare that, this is a good reference for those, a quick reference for those changes. And at this point, we've made it to our third polling question. What changes to UBI will have the biggest impact on you? And I'm sorry, if you don't have any unrelated business income, I guess you can just say which one you think is the most impactful for your organization. But would it be the UBI bucketing, the reduced corporate tax rate, taxability of fringe benefits, so now an inclusion whereas you might not have had UBI before, now you have fringe benefits that are now unrelated business income, or is it the changes to your NOL, the application of your NOLs going forward, or bonus depreciation? Right, I'll give everyone a second to make that response. And it seems like fringe benefits and bucketing are the two most impactful changes. All right, moving on because we don't have a ton of time left and I want to save time for the rest of the presentation. There are major sweeping changes to international tax law. As Tracy mentioned before, how this actually impacts exempt organizations is up in the air right now, but I think it's good to touch on some of the areas that might be impacted. In the slides, I've included a broad range of the changes translated to as plain language as possible for the international tax regime. But basically what's happened is that the U.S. is changing from a worldwide tax system to a modified territorial tax system. And what that means is that there's going to be some changes moving forward, starting as of 1/1/2018. What is going to happen now is now that there's going to be changes to the tax structure, we have a one-time cleanup this year. So before, what's happened is that a lot of corporations have kept their earnings and profits offshore. Because of our worldwide tax system, once you bring that money back in the U.S., that's when you pay tax on it. So a lot of corporations have kept their monies offshore. Now, this doesn't really apply to a lot of our exempt organizations. I'd say most exempt organizations that we have, we see foreign activities in two ways. For the most part, we see them in foreign operations, so organizations that have decided to create a program overseas, and so as such they've incorporated in that other country, and they have true related activities and programmatic activities happening in those foreign countries. Or we see it in international investments in our alternative investments. So hedge funds that have foreign investments, they're corporations that an organization is invested in, more of our passive investment activities. So a lot of these rules, it seems like initially do not apply to exempt organizations. However, we're not seeing specific carve-outs that state that. So when we're getting reform coming down the pipeline in the international area, we're not quite sure how that's going to impact our organizations. The biggest changes are reported on this slide: the one-time transition tax, dividend received deductions, GILTI, deductions for foreign-derived intangible income, and base erosion and anti-abuse tax. The one-time transition tax is something that's going to be impacting organizations as of 2017, as of 12/31/17. And what that is that organizations that have operated and have earnings and profits overseas are now going to have to bring in those earnings and profits here into the U.S. and pay tax on them at a reduced rate, at 8 or 15% rate, depending on certain characteristics of that income. There is no specific exception for tax-exempt organizations, but generally this type of income is deemed to be dividends, and dividends are generally not taxed unless the business or the dividend is debt financed. So we're not sure how this is going to impact our organizations. For our private foundation clients out there, we might see an influx in dividend income and investment income, but that income, is something that's going to come through on K-1s. So for your reference, there's some more information and some takeaways to the international tax change. But for our nonprofit clients, for our exempt organizations, the biggest takeaway I think is going to be that if you have foreign filings, if you have foreign investments, if you have alternatives, and you file 926s or 5471s or those types of forms with your Form 990, the reporting for those forms are going to be enhanced. So I'm going to throw this over to Tracy for charitable giving.
All right, great. Thank you. So we thought it was important, even though some of these provisions won't have a direct effect on your taxes or your filings or your employees, it could have an impact on your revenue sources. So we thought it was important to touch on a couple of the individual provisions that could affect your revenue stream. So the first one is increase in the standard deduction. As you've likely heard, the standard deduction doubled for individuals filing in the U.S. So they're estimating that 95% of taxpayers are no longer going to itemize. What the best guess is on how this is going to affect charitable giving is those people who were always charitably motivated, had missions and causes that they believed in, they're going to continue giving regardless of the tax deduction. But you could see an impact for your donors who were in those lower income thresholds, who may no longer be itemizing, who wanted those charitable contribution deductions. Or it might just take a little bit more persuasion to get them to donate the way they have in the past. Hard to guess kind of how this is going to all shake out, but that's one of the concerns. On the other side of the spectrum, which is your higher net worth individuals who tend to be your larger donors, we do have a doubling of the estate and gift tax exemption and generation skipping transfer tax exclusions. Both of these provisions were effective 1/1/18. So the sunsetting of the estate tax exclusion out in 2025, I believe, could influence some donors to go ahead and include a lot of charitable giving in their estate plan, but it may end up for some of those older donors who may not need to plan past 2025, it may reduce the amount of charitable assets that come out of that final estate or out of trusts. So the other thing to think about there is the states haven't adjusted their thresholds yet, so it's not like all thresholds have increased, but it's certainly made estate tax planning more challenging, especially with the sunsetting, lots of moving parts. But many exempt organizations are concerned that this means that their large bequests may not be quite as large as it was. Also for charitable contributions, if you are a college or university that really needed that seat licensing fee, effective 1/1/18, they've repealed the 80% charitable contribution deduction for those seating rights. So many athletic programs that did survive on that are trying to refigure how they price their tickets and how they deal with their donors who have always gotten that 80% deduction. A benefit to the individuals is the increasing of the AGI limitation for charitable contributions of cash to public charities. The limit was increased from 50% to 60%. So it's kind of a narrow band, but many donors only give cash to public charities. So there's many donors who would benefit from this additional AGI limitation. For our higher education organizations who may be on the call, the first provision that was affected, we now have income from discharge of certain student debt on accounts due to death or total disability of the student. It would be excluded from taxable income for debt discharges occurring after December 31st, 17. It expires in 2025, so your students do have another way that they can have that student loan debt forgiven without it coming into taxable income now. Parents are allowed to use up to $10,000 annually per student from a 529 college savings plan for K through 12 education. These plans have been in place for a long time, but they were always for higher ed, so your bachelor's and beyond. Now you can use some of those funds for K through 12 education. We have a brand new 1.4% excise tax that applies to endowments just to private colleges and universities, not the publics. But you have to have more than 500 students, more than $500,000 per full-time student that's not used in exempt purposes, which is generally thought to be your endowment. And more than 50% of the tuition-paying students are located in the United States. So when you pull the survey of which schools this is going to impact, there's only 29 or so who are expected to be paying this tax. And I had read in an article that there are some members of Congress who would consider getting rid of this provision if other forms of transparency and making sure that endowments are being spent to reduce tuition were put into place. So we'll see how this one does. But since it really only affects 29 to 30 private colleges and universities in the U.S., they have a great lobby, but that's kind of a small group of organizations affected. So we'll see if this one sticks. For tax-exempt bonds, tax exemption for advance refunding bonds has been repealed for bonds issued after December 31st, 17. So the idea is if you go out to the tax-exempt bond market and you issue a bond that is tax-exempt, then I, as a bondholder, wouldn't have to pay income tax on that interest that I receive on the bond. If the nonprofit can go out and get a better rate a couple years into that bond, and it makes sense from a cost standpoint, you could advance refund that bond. So you go out to the bond market again, get a new bond, take that money, pay off the old bond, and then you've got a reduced interest cost to the nonprofit. Before, the interest on both of those bonds, both the original and then the refunding bond, would have been tax exempt to the bondholders. But now for those advance refunding bonds, so that refinance that happens before the original bonds come due, that refinance bond can't be tax exempt. So it's going to be more expensive to refinance bonds if you're doing it in advance of when the normal call dates would be. They've also repealed the authority to issue tax credit bonds and direct pay bonds after December 31st, 17. These are those Build America bonds that were out for several years. With that, we've got 6 minutes left and another final poll for you. So if you could take a look here at what we've got on the screen, which provisions that we've talked about today will have the most impact on your organization. So we have compensation and fringe benefits, we have unrelated business income, the international provisions, the individual or estate tax changes that affect charitable giving potentially, or some of these other provisions that we just talked about specific to higher ed and bonds. Or none of the above. Maybe you've listened through the webcast and you've heard lots of great information but don't hear anything that's going to have an impact on your organization. You could please select one of the radio buttons there and click Submit. All right, I'm closing the poll to keep us moving. Looks like most people who were able to answer the poll said the unrelated business income provisions, which we certainly see that's going to have a lot of impact on organizations. Compensation and fringe benefits, that is a close second, and then the charitable giving provisions finally. So we wanted to give you, on the next 2 slides, some of the provisions that you may have heard about in the news that didn't make it into the final legislation. We have a word of caution here. We saw this when Dave Camp came out with his recommendation on changing the tax code. He came out with a very comprehensive list of suggested changes to make to either raise revenues or to kind of stop up some holes or problems, make policy changes. We saw years after Dave Camp's proposal, those provisions coming off the shelf and being included in current legislation either as ideas that they thought needed to go forward from a policy change standpoint or as revenue raisers to help balance other bills. We could see the same thing here. These are provisions that in some cases were in final proposals up till the last day and then were taken out as part of the committee reconciliation. So we could see these resurface. The first one is allowing 501c3 organizations to make political statements without jeopardizing their tax-exempt status. This was the repealing of the Johnson Amendment that President Trump was very vocal about, wanting to see go through. It did not go through. So to the relief of many 501c3 organizations who didn't want to have to get political or liked having a reason why they weren't, they were happy to see that that was pulled from final legislation. They've been talking for years about simplifying the private foundation net investment income tax. Right now we have a 1% or a 2% rate depending on how your spending has been over the last 5 years. The proposal was to simplify it to a 1.4% flat, no differences. That was pulled out as well as a provision that had to do just with art museums qualifying as private operating foundations was pulled from final legislation. Only income derived from research that was made freely available to the general public would have been excluded from unrelated business taxable income. This would have been a significant change in both the healthcare sector and the college and university sector because currently there's lots of exceptions from research being taxable. That provision would have made much of that research taxable, but it was pulled. Treating licensing of an organization's name or logo as unrelated business income also was pulled, another one that would have been a huge revenue raiser. There was several items in the education area that were on the chopping block, the deduction for interest paid on student loans, qualified tuition and related expenses, exclusion from gross income for interest on U.S. savings bonds that were used to pay higher ed expenses, and the last one being the biggest, the exclusion from gross income for employer educational assistance and qualified tuition reductions. All of that survived, so no change due to this legislation. The next bullet point, though, I would not be surprised to see changing in the not-too-distant future, and it's the simplification of the education credits, the American Opportunity Tax Credit, elimination of the Hope Credit and Lifetime Learning Credit. There's a lot of abuse in this area, so highly likely we'll see that one resurface. They talked about getting rid of the employer's convenience exception for housing, providing housing for the convenience of the employer. They also were looking at additional reporting requirements for DAF sponsorships, but we're going to have proposed regulations coming out shortly for DAFs anyway. That one did not make it in. WOTC credit is still alive and well for now, the Work Opportunity Tax Credit, and they were talking about repealing tax-exempt status for private activity bonds, also did not go through. So we have some additional webcasts on our website. We definitely encourage you to go and look at those on-demand webcasts if there's anything you wanted to hear about in more detail that we didn't go through, especially relating to international and business and individual provisions. We have alerts there as well. We've also provided some tax reform resource websites for you, including our URL at the top, with several others with very helpful information. So free resources for you to go and get more details. With that, I'll turn it over to you, Emily.
Awesome. Thank you, Tracy, and thank you, Lauren, for a great presentation today. We certainly covered a lot of material. If you have any questions, please submit them through the Q&A window, and we will do our best to follow up with everyone after the presentation, or you may reach out directly to Tracy or Lauren. Their contact information is here on this slide. If you would like to learn more about Moss Adams tax reform resources, you can check that out in the slide deck and handouts widget to the right of your slide view. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window to the right of the slide view. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 2 weeks should you have any difficulty downloading it now. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us today, and we hope you'll join us again next time.